Welcome to another episode of the Michael Yardney podcast. In today's monthly Big Picture episode with Pete Wargent, we're going to dive deep into, the big picture, the trends that are going to influence the direction of our economy and our property markets. Look, we're staring down the barrel of 12 interest rate rises, battling stubbornly high inflation, grappling with a wages decision that risks spiralling the wage price whirlpool. It's no wonder that some commentators are growing increasingly worried about the looming prospect of a recession in Australia later this year or maybe next year. But don't despair. Together, Pete and I are going to pass through this dense topic. We're going to break down the various factors. We're going to give you some insights, and we're going to discuss the trends and what they mean for you and for the future of our economy and our housing markets. So whether you're a seasoned investor, a business owner, or simply just interested in what's going to happen to property, this episode promises to help you get some clarity on what's ahead. So let's get started through the journey of the economic landscape.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
In these monthly Big Picture podcasts, Pete Wargent and I discuss the macroeconomic factors affecting our economy and our property markets. And as always, boy, has a lot happened since our last show. So I'm delighted to have the brilliant Pete Wargent join us once again as one of Australia's most respected financial analysts and commentators. Pete brings his invaluable expertise to help us navigate this ever-changing landscape that we're working our way through. Hi, Pete.
G'day, Michael. It's good to see you again. The last time I saw you, you were holding court on stage at the Gold Coast, so good to catch up again.
At Wealth Retreat, and now you're on the other side of the world.
Yes, it's amazing, isn't it? With the wonders of technology, we can reconnect, and it's almost like I've never been away.
Well, you're keeping track of what's going on with Australia, the Australian markets, the economic data. I follow you closely on Twitter and your daily blogs. And the new economic data suggests that Australia's economic growth is teetering on the edge. It's threatening our economic future. A lot of people are now wondering, is this going to lead to a recession, maybe later this year, maybe early next year? But one of the things that seems to have changed in my mind is the Reserve Bank has become even more absolutely committed to return inflation to its target. The rhetoric seems to have changed a bit. Phil Lowe seems to be prepared to do this at almost any cost. In other words, bring inflation down. And at the moment, it's slowing economic growth, and it's creating a lot of concerned consumer confidence. I guess we're going to have a bumpier economic landing than we'd hoped for. What do you see happening ahead?
Yeah, so on the recession point, GDP growth, we got the last quarter's numbers out just recently, 0.2%. So near enough zero, no growth at all.
This was for the March quarter, so it's retrospective, yeah?
Yeah, so they're a bit slow to report the numbers in Australia, not like in China where they can seemingly knock over the numbers in a week or two. But it's, so the numbers January to March, 0.2% GDP growth. But you got to remember, we're in a period of record high population growth. So if you take into account record population growth and look at what they call GDP per capita, well, we kind of are going backwards. So there's always this sort of argument, would you be better off having a slow and steady growth in the economy, or would you be better off having a boom and then coming backwards a little bit, which might leave you in the same place overall? And I think this is, I guess, happening to a lot of countries around the world. There was a sort of a boom on the reopening, and now we're having to go through a slowdown, as you mentioned, just to get inflation back to target. Now, if you look at what the Reserve Bank is forecasting, GDP growth this year, only really very lackluster, 1.25%, and population will probably grow by 2%. So it's going to feel like a lot slower in the economy. Unemployment's going to start rising again from 3.5% to say 4% by the end of the year, according to the RBA. But I think the big thing is inflation, as you mentioned. They want to get that back down to the 2 to 3% target, which on the current forecast actually isn't going to happen until the end of next year. They're just really concerned about that. They just want to make sure there's absolutely no chance of inflation breaking out and getting away from them again.
Well, the Reserve Bank raised interest rates in June, and they hinted that there's going to be at least another raise, right, or even more. All the banks have changed their forecasts as well as to where interest rates are going to stop. But they're also suggesting that later this year, early next year, the Reserve Bank's going to start lowering interest rates. That's all the four big Australian banks are suggesting that. I guess they're thinking that maybe the Reserve Bank's going to overshoot the market a little bit.
I think this was always the case. It was once interest rates peaked, they were going to come back down. All that's really changed, though, over the past couple of months is that we're going to be higher for longer, and it will be longer until we see interest rates coming back down again. One of the things we've really seen over recent years has been this kind of narrative cycle. And if you go back to 2020, all the worries were about, lack of population growth, border closures, massive job losses. And the Reserve Bank was talking about building a bridge to the other side of lockdowns. Well, you fast forward to now in 2023, we've got too much population and population growth. We've got too many people in work. But I think now in the property sector anyway, we're still sort of thinking about building a bridge, but we're looking across now to the other side of these interest rate hikes. They've absorbed the rate hikes today surprisingly well, actually. The property market's holding up very well, all things considered. And eventually the inflationary pressures will fade and rates will start coming back down again. But in the meantime, there's going to be a bit of pain there, especially for people who borrowed, I guess, overstretched a little bit during the pandemic. And in some of the regional markets in particular, we definitely saw that with people buying. You remember when people were buying places on the Sunshine Coast, sight unseen, and bidding miles over. Yeah, I mean, that's where people are going to get caught out, I guess, is where people overpaid in some of those regional markets.
Now, just getting back to that concept of a recession, that's really where gross domestic product, GDP, goes negative for 2 quarters. Now, we had an almost sort of recession during the beginning of the pandemic where there was a 1 quarter of virtually no growth and then another quarter of negative growth. But having said that, people had jobs. We had all those stimulus packages and most people didn't feel it. And it's really going to be much the same now. If you have a job, as you said, unemployment's going to rise a bit, 4%, maybe even 4.5%. But the last big recession I went through in the early 90s, unemployment went to over 10%. So if you don't have a job during these challenging times, then the recession will hurt you. But if we have a couple of periods of not strong or negative growth, but you've got a job and you can pay your mortgage, I think most Australians are going to get through these challenging times.
Yes, it's a bit of a misnomer, isn't it? Not every recession is the global financial crisis or the Great Depression. If GDP growth goes backwards or goes backwards on a per capita basis for 2 consecutive quarters, well, yes, that's what they might call a technical recession or a technical per capita recession. But if unemployment's still 4% or 4.5%, it's not really the same thing as you think back to sort of 2007-8 when there was genuine panic as banks were collapsing and jobs were going left, right and centre, probably worse in other parts of the world, especially Europe and the US. But yeah, I mean, that's not what is forecast at the moment. Obviously, there have been some bank failures in the US, but there's been some very speedy bailouts too. So yeah, I mean, forecasts can always be wrong, of course, but at the moment, well, we're not seeing a recession in the forecast, but a lot of economists are like, well, this is obviously a bigger risk than it was because interest rates have gone up so quickly.
Well, again, all this is happening because interest rates have gone up because the Reserve Bank's trying to slow inflation. And that's the only tool it has got, interest rates. On the other hand, the government could also help slow down inflation because government spending, there's not just you and me spending in the shops, but government spending leads to inflation. And they're doing a couple of things that is actually stimulating inflation. I guess one of them is the fact that a lot of people are coming into the country and we understand why that's happening, but they're coming in with money and they're spending and they've got to buy new items to fill their houses. And the other big factor has really been that recent minimum wage increase. That also is going to fuel inflation.
It hasn't helped, I guess. I think people like to politicize these things and sort of suggest, well, interest rates have gone up because of the changes to award wages. I think that's not strictly speaking true. Certainly, if you look to what financial markets If you looked at their reaction post-budget, there wasn't that much. I think just to run through the numbers, so the minimum wage goes up 8.6%, which I think is excellent for those people because, well, the cost of things like food and fuel and rent have all been going up very quickly. But it's only around 1% of workers in Australia on the minimum wage, and a lot of those are part-time workers anyway. So that's not going to move the needle in terms of spending in the economy. Award wages, 5.75%. Now, that is about 2.6 million employees, or about 20% of the workforce. So that is a significant increase. I think if you looked at that sort of post-tax, it would only be about 4.3%. So again, I mean, inflation's been higher than that. So I don't think it's going to stimulate massive spending in the economy or anything like that. But I guess that there's a time when people are twitchy about inflation, inflationary pressures. It's just a little bit more fuel on the fire. And it's, I guess, one of the things that will be front of mind for the Reserve Bank is, well, let's make sure we're not raising the expectations of wage rises and price gains all the time. And they're just really trying to nip it in the bud.
Well, as you mentioned a moment ago, despite all this, despite the 12 interest rate increases, despite high inflation, despite all the negative sentiment, our housing markets in general have been very resilient. Now, Andrew Wilson came out with it late last year, early this year, showing his index was increasing. CoreLogic have, PropTrack have, and now just recently, the official statistician, if people aren't going to believe the real estate research houses, the Australian Bureau of Statistics came out earlier this week. But it was, again, with their late statistics retrospective, but they showed how much prices have increased in the March quarter. And boy, that was 3 months ago.
There's definitely been some uptick. And interesting to see Westpac and National Australia Bank put out their surveys. Westpac does a monthly consumer sentiment survey, and yes, consumer sentiment's been wallops, but if you look at the house price expectations, though, they're still rising even now, though they were very, very low around about October last year. That was kind of the peak of the fear, so to speak. But since then, expectations for house prices have absolutely rocketed. They're still rising in June. So why is that? Well, I think one of the reasons is people are expecting the interest rates increase to be temporary, but also there's just no stock on the market. If you try to find something good to buy, a decent house, there's people crawling all over it. I guess that really reflects a shortage of housing and a massive underbuild that we're going to see over the next few years. So I think people are actually, to some degree, just looking beyond the interest rate hikes and saying, well, look, it's not a great time to be a renter. And if I can possibly buy, I'm going to do that anyway.
Sure. Well, that's happening particularly in our capital cities. Having said that, rents are going up significantly as well, almost double-digit rental growth in our capital cities. And as we've said, each time we get together and chat, there's no end in sight to this because there's very little new construction happening.
I think there are some parts of the country where rental vacancies are rising significantly. Actually, in the capital cities, there's two, Canberra and Hobart. Well, the other 6 capital cities are very tight. Some of the regional markets are cooling as well. But I think if you look at the leading indicators, so for example, SQM Research does an asking rents index, which kind of tells you what's coming because it does take time to feed through to the official rental figures. Well, asking rents for houses in the capital cities up 17% over the year to this week, and asking rents for units are up 22%. And in Sydney, 26% per unit. So it's, as you said, there is no end in sight. The pace might slow, but rents are going up. And this is certainly the fact that it's a landlord's market. That is definitely one of the factors that is encouraging people to buy. There's also things like stamp duty discounts or stimulus in play. So that's encouraging first home buyers in New South Wales as well. But the rental market is tight across most of the capital cities now, not everywhere in regional Australia though.
Definitely. Now, getting back to house prices though, it's not every market that's picking up, and certain markets are doing better than others. And recently some research came out showing how many people are actually buying properties with no or minimal mortgages. Now, of course, that's not the typical first home buyer or in fact the typical Aussie, but those people who've bought their first home, baby boomers who bought their first home 30, 40 years ago and paid it off, they're taking advantage of the lower prices, because even though prices have moved up, they're still lower than they were 12 months ago in everywhere other than Perth. People are still moving house. It's more the upper end of the market that's improving, Pete.
When you said that interest rates are a blunt tool, and that's a really good example of why. Not everybody has a mortgage. It's a surprisingly high percentage of homes are bought with no mortgage at all. Often when people have sold a previous property or they're simply debt-free. There's lots of households for whom changes in interest rates upwards could be a good thing if they're savers. Yes, it's a very fragmented market at the moment, as you mentioned. There are some parts of the market. See, very few people are keen to buy new at the moment. There's a lot of risk around, a lot of builders and developers going bust or just not completing projects. Materials costs have increased, so people are worried about cost overruns. So if people have got a nicely renovated home or a relatively new build home, there's plenty of demand for those. But for new property, well, that's really crashed. I think the lending to buy or build or construct a new home, it's the lowest since September 2008. So that's messy. Yes, there's still a bit of building in the pipeline, but if you're looking a year ahead or 18 months ahead, gosh, there's going to be a real shortage of places to live.
Definitely. So, okay, some people are thinking, well, if I'm going to take advantage of this, the beginning of a new cycle. Now, I don't think either of us are suggesting we should try and time the cycle, but if you are in the financial position to do it, hey, why not take advantage of the cycle as well? And people are wondering where. Interestingly, this week, Tim Lawless from CoreLogic came out suggesting that Melbourne has got a real competitive advantage. That's partly because Melbourne has underperformed since COVID. Melbourne house values increased by only 1.6% since March 2020 and now. And that's significantly lower than the other capital cities. Sydney's had, Adelaide's been a great performer, but Sydney's prices have grown 16.5% since the beginning of COVID. Adelaide 45.2%. Melbourne, I think partly the lockdowns and the challenges that have occurred because we were locked down for so long has underperformed in the short term. It's actually meant that the gap between Melbourne property values and Sydney has widened. And so interesting. I'm not suggesting you should invest anywhere in Melbourne, but I found his assessment quite interesting.
A lot of people left in between the lockdowns, even in some cases during the lockdowns where they could, and after the lockdowns. A lot of people went to southeast Queensland, understandably, but now that's definitely reversing. People are heading back to the big cities, and I guess a lot of those who left Melbourne and Victoria would be heading back.
Well, the gap between Sydney and Melbourne house values is now 30%. That's the biggest divergence since way back in 2006. And as you say, with people coming back and the migrants coming back, one of the reasons people choose where they live is cost. But I think another one is actually just where their jobs are, where the amenities are. And Melbourne has got a lot of those as well. So we're not saying that's the only place to invest in. There's not one Melbourne market. There's houses, apartments, villa units. There's inner city. There's inner suburban. There's outer suburban. So it's just an interesting point. One can't just, now that there's a new cycle starting, just buy any property. I think, as you said a moment ago, our markets are more fragmented than ever. So one has to be very careful and see what's going to drive property values moving forward.
There's some more population stats out this morning as we record. For the last quarter of available information, net migration was plus 106,000 and population growth was 129,000 for 3 months. So
for 3 months.
Yeah, so the calendar year for 2022 is going to be a record breaker. And I think if you look a decade out, then Melbourne will be the city with the greatest population growth in absolute terms. So there's a massive amount of demand. There's this real supply issue as well. Now, to pay for the lockdowns, the Victorian state government has introduced a new, a change to land tax. So they've increased the scope of the land tax. So for people with taxable value, land value of $50,000 and upwards, there's a fixed charge, and also there's an increase in the rate of land tax. Now, there's a cyclical thing going on here at various stages in the cycle. that's really painful for landlords. At this stage, though, they're just going to pass that on as higher rents. The rental market is so tight and there's so much demand for rental housing coming. That's really going to be reflected in higher rents. But it's just one thing to watch out for when you're looking at Melbourne. But that said, 10 years' time, the population growth over that period is going to be, well, huge.
Well, if you do the sums, the average investor will be paying about $2,000 extra a year in that land tax. So, and it's aimed at a 10-year, it's got a 10-year lifespan. Let's see what they do in a decade, if they actually get rid of it or not. But if you're going to pay $20,000 extra over 10 years, and remember, land tax is tax deductible, and that's a bit strange, but it's a state tax, and your income tax is a federal tax, and that's why you can deduct it. If you're spending $20,000 a year over 10 years in a tax deductible form, just look at how much capital growth you're going to get, and that puts it again in proportion. And it's not a reason to get out of the market. There's a lot of knee-jerk reactions initially occurred. Oh, no, I'll just get out another. It's just, I don't think people like all these impositions. They don't like the government treating property investors as an ATM. They don't like the government interfering with what we can do with our tenants.
It's one of the reasons we've had the rental shortage has been the demonisation of investors, always looking for somebody to blame. I think the Labour government had grand plans for the build-to-rent sector to step up and supply housing. But actually, look, take a look at that. If the cash rate's 4 or 5%, it doesn't really sound so appealing suddenly for developers. I think when interest rates were zero, they were looking at the rental market and thinking, yes, steady income streams. But with interest rates, well, you said 12 interest rate hikes, but it's really more like 16 if you look at the quantum of the hikes, 4%. And suddenly, well, is build to rent even going to work with that cost of capital? I'm not so sure. So yes, they've got real problems here because they've knocked so many landlords out or repelled so many landlords away from the market with changes to things like tenancy rules, land taxes, rental caps. There's just so many ideas being thrown at the market and people are just drifting off elsewhere. So that's going to be a real problem now for federal and state governments in terms of how they're going to supply the market. They used to do it with foreign buyers, but of course they got taxed out of the market as well. This is going to be a key story or theme over the next few years, is just the shortage of housing.
Very much so. And it's also been suggested by some of the property bears that people are going to just have to sell up their houses. I know you follow them. I follow you closely on Twitter, and every day I get your daily musings, and I'm going to leave a link to that in the show notes so people can also learn about your thoughts on what's going on. I definitely recommend they follow you on Twitter, where you retweet a lot of people's commentary. But there's a couple of people suggesting still that there's that cliff coming when fixed interest rates expire, or just interest rates going up, and there's going to be a whole lot of mortgagee sales. But it seems that risky lending is at the lower end of what's been going on over the years. It's virtually at record lows. Low deposit lending's fallen, high debt to income lending has fallen, interest-only loans fell. The banking system seems pretty sound, Pete.
If anything, they're going too hard on this. They're trying to remove all risk out of the system. As you mentioned, low deposit lending's at record lows, high debt to income lending, record lows, low doc loans, which used to be a fairly big part of the market, is basically gone. Interest only lending used to be about 40% of the market by value, which was too high, but now it's 11. They've really just taken all of the risk out of the system. But I mean, I would say arguably though, if you want a stronger system, you actually need some stressors in the system. It's a bit like the Greek theory of hormesis. What doesn't kill you makes you stronger, as they used to say when you were growing up. It's commendable that they're trying to remove risky lending, but it's gone too far now. We've still got a 3 percentage point lending buffer. So, there's so much risk being taken out of the system. I think on the point about forced sales, I get this as well on the social media. I'd say just look at the numbers. The stock for sale on the market is about 30% lower than the 5-year average. And if you go back, let's say 10 or 12 years ago, now think about the population growth in Australia over that time. It's been enormous. Well, the stock for sale is about half. It's absolutely so tight out there. So yes, of course, there will be some forced sellers. That's beyond doubt. And some people will always choose to sell as well. Some landlords will opt out. But yeah, at the moment, I don't think we're talking about a rush for the exits. We've got the opposite problem. People aren't selling, and stock for sale is so tight that that's actually what's underpinned the market.
Well, there are two sorts of people in the market: home owners, and they're not going to sell up because interest rates are high. As long as they've got a job, they'd rather eat Maggi noodles than sell up their homes. And the banks are going to help them out. We know that the banks don't want to be mortgagees in possession. So if interest rates have risen, the banks are still friendly and accommodating. And yes, investors are selling up, and that's a shame. But there's actually new investors coming in the market and more first home buyers there too. So there isn't a flood of properties on the market. So what would make property values overall fall significantly if there are more properties up for sale and no one wanting to buy them? But at the moment, that's not the situation.
No, I think if the cash rate went high enough, then that would damage borrowing capacity, and that would just mechanically push down prices. But at the moment, well, it hasn't happened. We've got prices actually rising. I think most people are thinking, well, at some point the rates are going to come back down again. But yeah, usually when you talk about falling house prices, significant falls, I mean, you're talking about either very high interest rates, oversupply of property, which we just don't have, or if you've got a real surge in unemployment. But again, I mean, the unemployment rate's 3.7. It's the lowest in 50 years. So we haven't got that problem either at the moment. If those factors change, of course, yeah, that could change the dynamics. But at the moment, well, house price expectations, they're 32% higher than they were a year ago. So, yeah, big change.
Having said that, I was surprised with the April home loan figures. Now, again, they're the latest ones that have come out, and that is backward looking, and they need to be seasonally adjusted. And April's a funny month when there's Easter and school holidays and long weekends. But home loans figures went down, and that's a leading indicator. It suggests that if fewer people are getting loans, house turnover, and I guess therefore prices, isn't going to rise as much moving forward. Now, refinancing is happening a lot, but people they took a pause over April.
Those lending figures, I guess you've often got to dig down a level and just look at the component parts. A big part of this is construction finance. It's completely crashed. It's at the lowest level in 15 years. And that was the global financial crisis, was the low reading in September 2008. So I've had clients talking to me about this. I was on a podcast only a couple of days ago where a good friend of mine was looking at, he's from an architect background, really wanted to build his own home down on the coast, but he said it just doesn't make any sense. There's cost overruns, materials costs are too high. You're much better off buying an established dwelling at the moment. And that's, I guess, a big part of it. Now, a lot of these graphs and charts we saw through the past 2 or 3 years, they went really high and then they went really low. I guess there is a bit of that going on. We got a big surge during the home builder stimulus, and now not so much going on. But I mean, it's very, very low. New home sales are the lowest in a decade. It's one of those sort of things you've just left with a big question mark. Where's the housing supply going to come from? I think in the apartment space, it can only happen when prices are going up, because nobody's going to be willing to buy off the plan at the moment. We haven't got foreign buyers. The build to rent is too small, and we basically need house or apartment prices need to be rising to get developers interested again, I think.
Well, we know that the government recognises there's a housing shortage, but it really hasn't come up with any smart ideas to fix that. And even if they come up with a really clever idea tomorrow, Pete, it's going to be a couple of years or even longer before, not that I can imagine they can come up with anything too smart. It's going to be a while for things to change. So no big change in sight in the housing market. I guess the easiest way would be to encourage investors, both local and foreign. I know there's a lot of fuss about foreign investors, but they're still only able to buy new properties, and they underpinned the construction of a lot of those apartment towers last time round. But why not encourage local investors to supply the accommodation that the government's not able to or prepared to do?
Well, there's certainly not much happening in terms of social housing units. Actually, the Queensland state government has made $600 million or so available for social housing units, which is a good start. But don't forget, the cost of housing these days, that equates to about 500 social housing units at a time when we've got population growth probably running at about 600,000 or so, or at least 500,000. So these are kind of drop in the ocean numbers. I think, yes, if the government was serious about getting housing supply moving, we'd sort of take away the stamp duty surcharges for foreign home buyers or foreign buyers of new property. But the lending assessment buffer is just too high. An investor's not going to be interested in buying new apartments when they're being stress tested at 9%. The lending's just too tight. But, the state government, lots of pushing deck chairs around. But actually, when you actually look at the policies they've put in place, like the Housing Future Fund, when you actually drill, it sounds good, but when you actually drill down into it, it's just a whole load of nothing. So, it's a little bit of talk about building some public housing. But again, the numbers are very, very small.
Well, I enjoy our monthly chats. I don't think we've come up with a solution for the housing issues. Having said that, I think it's brought some perspective that things aren't as bad as some of the property pessimists have suggested. In fact, most of the bears have gone back into their cave and hibernated. There's still a couple out there warning us about Armageddon, but I look forward to catching up with you once again. Now, if people want to keep in contact with you in between these chats, where's the best place, the easiest place for them to keep contact with you, Pete?
Easiest place, my daily blog, Pete Wargent Blogspot, all for free. And as you mentioned, I'm usually on social media most days, at Pete Wargent on Twitter.
What do you mean most days? You're always there.
It's a horrible addiction, but there's some good information on Twitter if you can get there, but you've got to filter through some nonsense as well. But it all goes with the territory, and I think yes, as you said, there's always something. That's the thing you find with housing markets. It was COVID in 2020. Before that, it was the Banking Royal Commission. Going back, it was the end of the mining boom. It was the GFC. There's always something that's apparently going to crash the market. And when interest rates start falling and inflation comes back down, it will be something else, So that it is, you've got to be a bit wary of some of the narratives sometimes.
There's always a reason not to get involved. But at the beginning of a new cycle, as we clearly are, if you're in the right financial position to do it, it actually seems to make sense to just explore your options. Thanks a lot, Pete. Catch up with you again in a month's time.
Pleasure. Thanks, Michael.
If you got some benefit from my chat with Pete and you don't currently subscribe to this podcast, just take a moment and on whatever podcast app you're on, follow the Michael Yardney podcast so that you get our regular shows. Now, in a moment, I'm going to share my mindset message with you, but just following on with our discussion with Pete, as we've said, we've had the interest rate rises and inflation means that the interest rates are going to remain a bit longer and the economy is slowing. That's what the Reserve Bank wants. And yes, some commentators are worried about the prospect of a recession. But as we said, despite all this, our housing markets have remained, well, I said stubbornly resilient, but it's just the fundamentals that are pushing up house prices and also making rents skyrocket. Now, look, as we've said, we've passed the bottom of the cycle earlier this year, and we're now looking at the beginning stages of a new property cycle. And an opportunity like this, it doesn't happen very often. This means that as a property investor, somebody who's keen to secure your financial future in property, I guess there's three things you can do. Some people are still just hunkering down. They're playing the game not to lose. They're shrinking away from these opportunities. And that means you're not going to reach your full potential because by the time you're ready to get into the property market, the market will have moved. At the moment, still, in general, values are lower than they were 12 months ago. While others are actually playing the game to win, they're recognizing times like this actually do give great opportunities, but you've got to follow a time-tested, proven strategy. And if you want to be in that third group, as many of our clients at Metropole are, I suggest you have a chat with my team at Metropole. By the way, we don't sell property. Sure, we have a buyer's agency that can help you buy a property. We actually have on-the-ground team, so we don't fly in and fly out, but we've got boots on the ground in the major property markets. But even before we talk about property, we actually start by putting together for you, building you a strategic property plan, because we want you to bring your future into the present now and plan to become the person you plan to become. And then we follow proven frameworks and strategies I fine-tuned over 5 decades and we've been helping clients with for over 20 years. And that's allowed them to outperform the averages because, as we said in my chat with Pete, the markets are very fragmented. So go to metropole.com.au. I'll leave a link in the show notes. And why not have a complimentary clarity consultation with my team? We're keen to share those frameworks with you.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to talk with you about following your passion. Because you've probably read or you've probably heard that to be successful in all areas of your life, you must follow your passion. But what if it's more than that? Now, recently, one of my colleagues said to me, passion's for losers. To be successful, you need obsession. He then went on to say, passion leads to a hobby, obsession leads to winning. Now, I don't know if I totally agree with this sentiment. However, I tend to agree that even though his views certainly challenge the common thinking of follow your passion and you'll be successful, I sort of agree with what he's saying, because I think the point he was making was you can be passionate about something and still take little action. But when you've got an obsession, you wake up thinking about it, you spend the day focused on it, you go to bed planning for the next day. And you think about what you're going to do about it, and you do something about it. Deep down, we all know that Olympic gold medalists don't win because they're passionate. They win because their sport is an obsession. And my friend went on to say that most people's goals just aren't big enough to be an obsession. They're only big enough to be a passion. Now, again, I think that's an interesting view. Of course, he's suggesting that most people don't think big enough and don't believe in themselves strongly enough to achieve huge things. It was an interesting discussion. Now, in my mind, being an entrepreneur is a full contact sport. Running a business isn't a 9-to-5 job. It's not for the faint-hearted. Being a property investor involves all sorts of challenges and obstacles and hurdles along the way. It requires a level of belief and commitment that causes you, the entrepreneur, the businessman, to fly on a trapeze without a safety net sometimes. Being a serious property investor takes courage, resilience, and out-of-the-box thinking. Does that require more obsession than passion? I think so. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?